get started today. So I have with me, I'm Brandon Thurgood. I've been here with Oxford Wealth Advisor for quite a while now, 4 or 5 years. I'm on the managed money side of business and also do some financial advising on the fixed side as well, but focusing more on the managed side today. I also have Rich Brady with me. Rich, if you want to go ahead and introduce yourself.
You bet. Rich Brady, I'm the general manager of our Austin office. Been with Oxford Wealth in a variety of capacities over the last 10 plus years, but been full-time running this office for the last 2.5. So I too am excited to be with you today. You know, there's a lot going on in the markets. And so we kind of created this once a month check-in with those that are affiliated with Oxford Wealth or those that are not, just to say, hey, what's going on in the market over the last 30 days. So Brandon and I are excited to be with you and talk about understanding active share and turnover.
Perfect. And I'll say, let's touch on a hot topic right before that, Rich, inflation, right? That's one of those things that kind of out of control right now, if you will. So let's touch on that real quick before we jump into the active share and turnover of these portfolios.
Yeah, let's do that. Brandon and I were chatting this morning about inflation a bit. It is, it doesn't take a lot to pick up a paper, to flip on the news, to hear about inflation. And so this is a hot topic. We wanted to talk about it right here at the top of this meeting before we jump into some specific topics. But what is inflation? Well, obviously that's the cost of goods and services in an economy. And if the costs are going up, are they going up? Are we dealing with a risk of hyperinflation? Or are inflationary pressures, that word, pressures, under control? And so coming out of a recession, just a little bit of background, coming out of a recession, there is always, in every recession that has occurred in US history, there is always inflationary pressure coming out of a recession. You cannot have what we had happen in our economy in March without having and government stimulus spending to individuals, to small business, and just general increase in government spending in general. That means there's surplus dollars floating in our economy. There's going to be a rise in inflationary with inflationary pressures. So I wanted to first off just articulate this is normal stuff. If you read the press, now realize the media is in the business of negativity, and negativity sells. And so they're trying to create a lot of noise around this topic. It is normal stuff. I do believe that is something that the government and specifically the Fed, Jerome Powell, are taking very seriously. We do not want out of control inflation. So as a result, they are taking proactive measures and are re-looking at the easy monetary policy that they have in place. In fact, this week we did hear that perhaps they are open to revisiting interest rates. They had told us that for 2 years they were going to hold the Federal Reserve rate fixed and absolutely have no changes until 2023. Well, this week we got different news. We got word that in case there is inflationary pressure sooner rather than later, they are looking at perhaps readjusting federal funds rate, which means interest rates could be going up, which would be which would then slow the economy down, which makes money harder to get. I wanted to just touch on what does inflationary pressure mean by way of my investments. Okay, so keep in mind, Oxford Wealth is built on safe money. Green money accounts, yellow money accounts as well. But let's talk first green. Green money is safe, secured, guaranteed accounts. We say on average, these accounts grow 3 to 5%. We're trying to keep up with inflation. Yellow money accounts take low market risk, but have upwards potential of having greater returns. So we just wanted to note that if you are in green money, if you are in yellow money and you're worried about where you're positioned, just sit down with us. We're happy, as you know, we sit regularly with our clients. We go through regular portfolio reviews, and I wanted to extend that again this morning. If you're concerned about inflation, let's sit down together in the coming days and let's schedule an appointment, look at your portfolio and make sure that you're positioned properly. Um, but we never act out of fear. We always act out of knowledge and out of strategy. So let's revisit your strategy and let's take a look. But inflation is something that is anticipated. The Fed calls this a transition. It's kind of a transition phase. They knew it was coming. It's not by surprise at all. So anyway, more to come on that, and we'll touch on that as we go, and just touch on that each month whenever we do these market updates. Okay, Brandon, back to you.
Perfect. Yeah, so today's topic is we're going to be talking about understanding active share and avoiding turnovers within portfolios. Now, active share is a little bit newer of a concept. It was introduced in 2009 it was written by a paper by the Yale School of Management. There was two. It was authored by two different individuals, Martin Kramers and Antti. I'm going to butcher the last name, but Petagisto. So it's a newer concept, but it helps investors understand, because there's a lot of mutual funds out there claiming that they're actively managed. And so if they're claiming that, we want to make sure that they're actively managed. And so that's what active share was introduced as by these two Yale authors in 2009. So what is active share? Before we get into that, let's talk about active versus passive investing. When we talk about active investing, let's look at some of the pros of this investing style. Right, with active investing, you have a hands-on approach. You have a portfolio manager that is managing that portfolio for you. They're making these trades, these buys and sells, and you're trusting them as an investor that what they're buying and selling is, number one, in your best interest, and that they're doing the right thing. Right, so you're putting your trust in this portfolio manager to actively manage and to get in and out of investments as they see fit, depending on different market circumstances. Another pro of these active portfolios is that they have flexibility of the investments, right? That's what the portfolio manager does. And also tax management. A lot of times with these active portfolios, you can offset certain gains with the losses. On the flip side, tax management could also be a con, because if they sell big gains, you now, as the investor, have incurred possible capital gains tax. So some of the pros for passive is going to be a buy and hold. There's going to be very little trading that happens within these accounts. You're basically going to be mimicking some type of index or the philosophy of the actual investments. These investments, these passive investing, have low fees, very notorious. I'm sure you've heard of the Fidelities and the Vanguards of the world. You're paying little to nothing for a lot of these different investments, and they're simple and transparent. You know exactly what you hold. It's not going to change much. It's maybe a few things here and there, but it's going to be very simple and transparent. You know exactly what you own in these passive investments. And then tax management, because they're not in and out of a lot of these different positions, typically you're going to have, as an investor, reduced capital gain. Now, when we're talking about capital gains, this is looking at non-qualified money and not the IRA assets. So that's very important to differentiate as well. Now, what are some of the cons with active investing? Well, because you have that portfolio manager, there can be human error. They might get out of something that performed really well. They might get into something that might perform negatively. So you always have that aspect of human error possible. Higher fees and minimums. These active mutual funds and accounts charge more. Not necessarily is that always a bad thing, right? But you have to look at what you're getting for what you're paying. If you're getting higher returns and paying more, that's okay. I'd rather pay more to earn more than pay less and earn less. And they can be closet index trackers. This is what active share was ultimately introduced as, because a lot of these active managers are saying, yeah, we're active, but in reality, they're investing in the same positions as these passive managers, but charging higher fees. So with those higher fees, your performance is actually reduced dramatically, even against passive type funds. And so some of the cons for the passive funds is you have volatility, right? You're in those positions, and because they're buying and hold, if the market's correct, you're going for the ride, right? You're at the top of that roller coaster, and you know it's coming. Well, not much you can do about it in those passive funds. They're going to stay there. Another con is you're never, I don't want to say never, in rare cases, you might minimally outperform a market. But that's what passive investing is right? You're just going to be following the market. Whatever the market does, that's what this passive investment account will do. And there's also no ability to react to those market changes. They can't sell out. So they're just in for the ride, and over a long period of time, typically that works. But as you get to those retirement years, as you start nearing retirement and are in retirement, if you're in passive investments, you need to be very careful that those investments aren't going to be exposed to a lot of volatility. And so that's the differences between the active and passive. So what we want to look at with these actives is, what is active share? So active share is it's a measure of the difference between the holdings in a portfolio and its benchmark index. So what that's saying is, let's say I have a large cap growth mutual fund, and they have different holdings in that. The benchmark might be the S&P 500. So they look at the differences of the holdings between the mutual fund and what is in the S&P 500. If they're similar and they have the exact same holdings, the active share is going to be 0, right? If none of the holdings are in common, you're going to have an active share of 100. And so when we look at these mutual funds, many of them don't actually disclose their active share yet. It's starting to catch on a little bit. I think Fidelity discloses all of their active shares with all of their funds on their website, and then a few other companies do. So it's one of those things that is starting to catch on, and the investors. It's important to know, because there is some correlation between active share and performance. And so here's the ranges down below. If you have an active share in a mutual fund of 0 to 20%, that is typically your passive fund. They're going to have very similar holdings to an index, to its benchmark. If you're holding an index fund, for instance, your active share will probably be 5% or less. If your active share is higher than that, then there might be some differences and issues. They might be doing some different tradings and things like that you need to be careful of. If you have an active share between 20 and 60, this is what we call, or the closet indexers, the mutual fund managers that claim that they're active, but they're still holding very, very similar holdings as the benchmark. They're still charging more fees, etc., but their fund is basically mimicking a benchmark. So as an investor, just be aware of what you're holding. Now, anything above 60, that's what's considered an active fund, as far as the active share number is concerned. So very important to differentiate between those three range groups there. Now, when we look at the active share performance, this is over a 13-year period. This is the study that those Yale professors did. This chart just basically explains that those funds, or those funds that had the highest active share over a 10-year period, outperformed those funds with a lower active share, to the tune of 2.8% over that 10-year period. Right? So higher active share over a long period in this study performed better than those funds that had lower active share. So that's just saying that, because you're not holding the same holdings, you'll have some that might perform better than what is in the benchmark. And so that's very important to realize with the active share. We don't need to be mimicking those things. And this chart right here just talks about the mutual funds. We're going back to 1980 in this chart, and we're looking at the mutual funds and their active share. Now, back in the 80s, you had a lot of funds with active share above 50 to 60%. They were actively managed, right? They had the hands-on approach. And as we can see, as time has passed by, that the active share in these funds has dropped dramatically to where it's no longer as actively managed. And you see a lot of mutual funds that are just tracking indexes. And that's fine. There's nothing wrong with that. But we just want, as investors, to be aware of what we're in and what we're paying. Because if we're paying more fees for a fund that is ultimately just tracking an index, we can improve our portfolio and improve our returns by getting into a fund that does the exact same thing while paying lower fees for that. So just be aware, because those closet indexers are, they're around, and so we're looking out for those types of things within the active share of a mutual fund.
Brendan, let me add comment here just to
Of
piggyback off
course.
what you just said. What we're looking for is there's nothing wrong with indexing. It's got its place in the industry. But what you're trying to avoid is you want a fund that has very high active share or very low active share and is indexed. And if you are invested in a fund that is what we're calling closet indexers, they're basically an index fund. We we use a phrase. You're putting lipstick on a pig, right? The reality is that they are index funds with a small tweak, and yet they're trying to charge higher fees. Make sure that you're either in all index or you're in complete, a fund that is very actively managed.
Exactly. Yeah. Good point on that. So with active share, let's jump into avoiding and into turnover. So turnover is basically the percentage of the funds or portfolios holdings that change over the past year. The more trades that happen within a portfolio or a fund, the higher the turnover percent or turnover ratio will be. Index funds, you'd expect to have a very low turnover, right? Because they're just tracking an index, they're passively managed. You're going to typically find higher turnover in those actively managed accounts. So when you're looking at mutual funds, we see that low turnovers typically between 0 to 30% of the holdings. So that just is a range there. And then you have a high turnover. Anything above 50% is going to be high turnover. Now you have to, this isn't, a religion by any means, right? You might have different funds that you have to kind of look into, because there's, for instance, a short term, if you have a bond mutual fund that invests in short term positions, it's going to have a high turnover because it has to replace those short term positions. And so you might find a lot of bond funds that might have 200% turnover in a year. That might seem really high, but because they're investing in all these short-term positions, they have to replace them. So take it within the context of what they're investing in. Uh, More than likely, you're going to find higher turnover with smaller cap companies. So the smaller companies typically have more turnover, a higher turnover percentage than those mutual funds that are investing in large cap companies. Growth type positions are going to have a higher turnover than those that are looking at maybe like value or core type positions in investments. And this chart on the right, I like this as well. This ties the two together with the holding period, how long they're staying invested in a particular company and avoiding that turnover in conjunction with the active share. And so if you have a high active share and you hold on to the position for a longer period of time, the results, definitely you could see the relative returns, pretty amazing. It was the only section to outperform or to perform positively in this chart here. Your next best guess is a long duration passive. So pretty interesting chart there. And so when we talk about mutual funds and the turnover, why is that important to pay attention to? in an article written in Forbes, they talk about the different costs of owning a mutual fund. And so I just laid them all out for you here. You have the expense ratio, which is the percent, which is the amount that you pay to be invested in the mutual fund. Doesn't matter what happens, you're paying that expense ratio. Now, in the study, they found that there's hidden fees that you as the investor may not know about. One of those fees is the trades or the turnover that happen within these mutual funds. These are not disclosed to you as the investor. You don't know them, you do not see them. So that's why turnover can be a very important thing to be paying attention to in these mutual funds. And that can equate to a fee, or I'll call it a fee, if you will, of 1.44%. That was the average turnover rate that was found out to be in this study. Mutual funds, because of that active investing that we talked about earlier, that it can create capital gains taxes. That's about a 1.1 fee. And then the sneaky behavior. I think we see this a lot with mutual funds. Some of those sneaky behavior things is you might have a manager that tries to sell the losers before, the end of a quarter where they have to report, and then they just buy some winners, at the end of the quarter, so to where it looks like they performed better than they did. Risk shifting, where they might kind of deviate from what the mutual fund was designed to do to try to squeak out a little bit more gain, before the end of a quarter. And then you have shirking, and this one's where, you have institutional investors and individual investors. Uh, Typically, I don't want to say typically, but shirking is where those mutual fund managers care more about the institutional clients than the individual clients. So you might have a mutual fund manager that cares more about the funds for institutional investors than a mutual fund manager will care for those individual. And that might lead to some laziness and underperforming on the individual investor side. And that average is about 2.49%. So when we add all these together, that's a potential fee, or a potential of 6.22%. So if the fund returned 10% and you incur this hidden of this, about 5% of this is hidden fees that you don't see, that cuts the gains in your mutual fund. And that's why we see a lot of mutual funds are either underperforming by just a little bit to the benchmark, or they're underperforming by quite a bit. And you may be questioning yourself, why? Like, it says they've returned this much and this and that. And well, you have all these hidden fees that you don't see, that are never disclosed to you, that just kind of eat at your bottom line. So just be careful of that. But 1.44% just in turnover. And what are these managers taught to do? In these active positions, they're taught to trade, right? They have to make these trades. That's, almost on a daily basis, that's what they're doing. And that's just creating money for them, right? Because there's differences between, the spread price. So that's how these companies get paid. But 1.44% is what the investor on average pay in hidden fees for trades within a mutual fund. Okay, so we'll just close it with this: is what options do you have? If you're invested in a 401k, unfortunately, there's not much you can do. You're limited to those positions that you have within that plan. Look for those mutual funds that have high active share, that have low turnover, right? That's what we want to see. If you're in an active traded account, high active share, low turnover, that will typically lead to the best returns. Or look for a passive fund with a low fee. So you want to find one or the other, or just, a little combination of both. It's okay to have an active investment and then a passive investment as well. If you can, I'm not saying that all mutual funds are bad, just know which mutual funds you're invested in and what they're designed to do. If you don't want to invest in mutual funds, there's ETFs. Again, this is going to be a passive type investment with very low fees. It's going to just track an index, a sector, commodity, or some other type of asset. They're starting to get a little bit more traction lately. And then you have a separately managed account. Picture this as a mutual fund that you own individually, right? Mutual fund, your money is just mixed in with a lot of other investors. With a separately managed account, your money is in its own little pool, right? You directly own each of those securities, and to top that off, they're professionally managed. So a lot of those cons for mutual funds are actually pros for those separately managed accounts. There's great tax efficiencies. You can offset gains with losses. You have that professional management. A lot of investors don't know or pay attention to these separately managed accounts because a lot of times they have very high minimums. But if you get in touch with financial advisors that are tied to, investment advisement firms, many times they're able to get you into these types of companies or positions at a much lower minimum. So basically, to close this up, Rich, do you have any other comments that you would like to add?
No, just well done, Brandon. I think the only thing I would add, I mean, we've talked about ETFs, we've talked about SMAs, we've talked about mutual funds. Keep in mind, each of you are in a unique situation. We do what we call a portfolio audit. Well, we will sit down and look at someone's investment accounts. We'll look for redundancy between mutual funds. We'll look at fees. We'll look at return. We'll look at risk and make sure that it's right sized for your objectives and your goals. We've done over 4,000 of these types of portfolio audits. We've got a lot of data. And so we make that available to you, whether you work with us now or you don't, doesn't matter. Let us do a portfolio audit. We'll look at your accounts and see how well you're positioned. And if you are optimally positioned, we'll tell you so. If not, we'll say, here are some areas that perhaps if you choose to work with us, we could add some value.
Exactly. Yeah. So just want to stress again, not saying that mutual funds are bad, just know what you're invested in and make sure that it's doing what fits within your risk levels, your risk tolerance, and your investment objectives. But thank you guys for joining us today. I guess we can stay on for a little bit. If anybody has any questions, feel free to go ahead. I'll just open that up now. And if not, we'll go ahead and let you guys can carry on with your weekend, and happy Memorial Day to everybody. Thank you for all those that have served and continue to serve for our great country.
You can feel free to use the chat button if you're uncomfortable speaking, or you can just unmute yourself and ask away. Or perhaps you can give us a call after. If you'd rather just pick up the phone and give us a ring, we can do that as well.
We need that little Jeopardy music going on. Perfect, everyone. All right, we'll go ahead and just end it here. Thank you guys for your time. Again, enjoy your weekend.
Thanks, Brandon.
All right, thank you, Rich.